Hello, I'm Jason Kelly. Thank you for joining me. In this video, I will show you one way to improve your stock market backtesting results. Now, this is a method used by my research partner Roger Crandell and me when we were developing the parameters of the 9-sig system. That's the 9% signal system. One common problem with backtesting is called curve fitting. That's when you take real stock market data from the past and you reverse engineer what type of system would have worked to maximize returns from that period. So for example, you just look at all the different inputs and you say, if the P&E ratio of the S&P 500 is X, then our system buys. As soon as that reaches X plus a different factor, our system sells. And you can look at that in retrospect and of course come up with, in hindsight, what would have been the perfect system at that time. The problem, of course, is that those times don't repeat. Let's look at this. On your screen, I will show the 2-year chart of TQQQ, which is the Nasdaq 100 3X fund, so a leveraged fund. And going back a couple years here. Now, if you are curve fitting to this, what you would see, you'd come up with a system that saw that rise in the beginning over April, May, June, into the middle of July in 2016, and you would have a system that was totally long during that period. You would be 100% exposed to that. And then at that peak, or at least that skyrocket higher in July, you would see what your system could have picked up during that rise to have sold, preferably right at the tippy top of that peak. And then you would have been comfortably out for the big crash that happened into the end of August. Then your system would buy and ride it up to the peak in November. Then you would sell at the end of December and buy again at the end of February. And there are so many systems people come up with that look like that. And they'll present the results and say, see, this system would have totally owned the market during this period. This would have tripled the returns of the market. That's called curve fitting because you don't know if the market's going to behave that way again. And so many of these measurements that people think are causative are actually just coincidental. So PE being at a certain level, other valuation measures being at a certain level, they're not triggering the downturn. They are coincidentally where they were when the market went down. So if you have a system that is based on those and you fit your system to the curve of the past market, then you are susceptible to being completely out of whack in future markets. So what can we do to get around this? We do want to look at the real market because we have to understand roughly how markets behave. Because as Mark Twain pointed out, history may not repeat, but it does rhyme. And so it is with the stock market. Future markets, all markets look similar, but they don't look the same. So how can we pull out of the stock market? In this case, the index behind TQQQ, the Nasdaq 100. What can we pull out of the Nasdaq 100's history to understand how it will probably behave in the future? Well, one thing we did, I'll show up on your screen, is look at scatter plots of the daily returns of TQQQ in the past. Look at this scatter plot on your screen. This is going back to 2010, so we've got 7 years of data on here. And each of these dots represents the percentage change for TQQQ on that trading day. Now you notice that most of them are clustered densely around the 0% line. And then as you get farther away from 0%, either in the plus area or the minus area, then you have fewer instances of daily change. So this scatter plot run through a spreadsheet, run through software, can tell us the nature, the characteristic of the price changes that have happened to this ETF in the past. And from that we can figure out, okay, if it's going to behave roughly like this in the future, how might different markets within the same set of randomized parameters work in the future? So here is the key from something like this. Why do we think the real stock market of the past is any better of an indication of stock markets of the future than a simulated market based on past characteristics? In our opinion, there is no better reason to switch over to looking at only real-life data in the past. Now, this is what we did with this particular test. Roger created 30-year markets based on the parameters of the Nasdaq 100 and TQQQ's index to create 100 simulated markets. Now here's an example of some of the things we pulled out of this. This is a pull quote from the 2017 Kelly Letter Note 1 sent in January of this year. I'll put it up on your screen there. It reads, "The maximum historical one-day gain of the Nasdaq 100 was 18.8% on January 3rd, 2001, and the maximum one-day loss was 17.8% on Black Monday, October 19th, 1987. The average daily deviation was 1.14%. After specifying these and other controls like them, he," meaning Roger, "generated random Nasdaq 100-like daily returns across 100 hypothetical 30-year markets." From this, we zeroed in on the parameters that were right most of the time. You can never get it right all the time. But what we do is run it through those 100 different 30-year markets that are based on characteristics of the Nasdaq 100 and look at what system would have created maximum returns in the greatest number of those 100-year markets and the greatest number of time frames within those, 130-year markets. I recommend you do something like this on your own. It'll get you away from curve fitting, and it will help you create a system that can handle a robust series of results from within the nature of what the past stock market has taught us. I hope this helps you. If you like this video, please do like it here on YouTube and subscribe to my channel. I'd also love to have you subscribe to the Kelly Letter, so swing by jasonkelly.com to learn more about that. Kelly Letter subscribers, I will see you on Sunday morning. Everybody else, have a great weekend.